Welcome to today's budget special, where we'll unpack what the Chancellor's announcements really mean for the insurance and financial advice professions. The budget is always a moment of signalling, but for our sector it carries extra weight. It influences consumer behaviour, capital allocation, solvency pressures, and the policy environment we operate in every day. This year's budget lands against a backdrop of subdued growth, sticky inflation, and elevated interest rates. For insurers, that combination affects everything from gilt yields and annuity pricing to capital ratios and claims trends. For financial planners, it shapes real returns, client cash flow planning, and the balance between guaranteed and market-linked products. Over the next few minutes, we'll cut through the headlines and focus on the parts that matter to CII and PFS members and the wider insurance and financial planning professions. I'm joined by Matt Connell, Policy and Public Affairs Director of the CII Group, and Eddie Grant, PFS Board Director, former Vice President of the CII, Board Member of the European Financial Planning Association and UK Government-appointed Cabinet Office Disability and Access Ambassador. Thanks so much for joining me today, Matt and Eddie.
Hi.
So let's get into it. It certainly wasn't a smooth introduction for the Chancellor, was it? I mean, before she even got to her feet, we had a rebuke from the Deputy Speaker for leaking details to the press over the past few weeks. And then we had the OBR leak as well. She said that it all fell short of standards that the House expected. But let's put all that to one side. And I'll start with you, Eddie, and just get your initial reactions on what advisors should think in relation to today's budget in terms of the advice they might be offering to their clients.
Thanks, Chris. Well, first of all, we're recording just over an hour since the Chancellor sat down. So like all budgets, there's going to be loads of information that's going to come out over the coming days. So it evolves, and the actual budget doesn't get go through legislation until probably June, July time. So there's lots and lots of things that are going to evolve. So it's really important that advisors think about the facts rather than the speculation and everything else. And you're quite right, the speculation has been pretty intense for advisors, but most importantly for clients. And if you have a client who's anxious, the value of advice and the reassurance an advisor gives has really proven its worth, I think, over the last couple of months. The other thing to say is, for me, the headline is 88 measures announced in this particular budget. So there's lots of things in there that are just not relevant for clients. So getting your advice tailored to your client and the circumstances, really, really important. Probably most advisors, and they're probably doing this already, what they need to think about is telling their client that they've got the budget, here's some headlines, but as we sit down over the coming weeks and months, we'll look at the implication of the budget for them as an individual and the plan that we've agreed. So for me, that would be the initial reaction.
Fabulous. Well, we'll come into some of the details in a few minutes. And for you, Matt, I suppose the headline came about 45 minutes into the budget, where she announced the freeze to income tax and national insurance thresholds for a further year until 2028, asking everyone to make a contribution, in her words. I mean, that brings another 750,000 people or so to pay tax, doesn't it? What did you make of those sort of the overall macro picture that she was painting for us?
Yeah, I think obviously the government has pinned everything on growth, and presenting a budget which increases taxes and still carries a commitment to growth is very tough. So I think what the Chancellor's done is she's tried to look for themes, good news themes around areas where there's particular chances for employment growth and economic growth. So there's lots of measures aimed at smaller businesses, a tax on dividends they've tried to reduce for startups, the apprenticeship levy aimed at younger people, helping younger people, increasing the age at which small businesses don't have to contribute to the
there was a whole package of apprenticeship funding, wasn't there?
Absolutely,
for under 25s, and the apprenticeships are going to be completely free for SMEs now, according to the Chancellor. That must be a really positive move for growth. And there was a £725 million announcement for a growth and skills levy as well.
Absolutely. So again, and I think that what the government's looking is to channel as much of that money as possible into small businesses who haven't been able to engage as much in the apprenticeship levy as larger businesses. So it really is saying that the government's on the side of the small person, small business, and looking at measures that perhaps put some of the burden more on larger companies, like the salary sacrifice measures, and looking to have as light a touch as possible on smaller businesses.
Not a word on insurance through this budget. Was that a surprise for you?
Not really, no. I mean, I guess with insurance, the thing that's always hanging over it is insurance premium tax. The big problem with insurance premium tax, of course, is that it lands heaviest on people who are highest risk, and often people who are highest risk, people with pre-existing medical conditions, for example, for life insurance. They're the ones who really shouldn't be paying higher tax. They're higher risk, but it's not their fault. So I think that's why politically that's something the government has steered away from.
Okay. And the Chancellor did also announce a review of how our tax system could evolve to help support entrepreneurship as well. A positive for you?
Yeah, I mean, every budget always contains a package of measures around help for venture capital. Again, the dividend, the dividend increase, not so heavy for startups as it is for other businesses. But I guess to some extent that is as much as the government can do under the circumstances. I think things like the increase in dividends, that's not something that the government would have wanted to do, if we hadn't had all the pressures around war in Ukraine, US withdrawing support from Europe, and then looking to pay for an increased commitment to European security through disability cuts, but then having a huge backbench rebellion. So I think some of the good news measures are great, but obviously you've got to look behind them and look at areas where the government has had to make changes they didn't want to make because of the global political and economic pressures they're under.
All right, well, we might come back to some of those other macro stories in a moment, but let's weave our way down. Let's go through the changes to pension, or the fact that there were no changes to pension reliefs, but she did introduce a 2,000 cap on salary sacrifice into a pension. Now, Eddie, what did you make of that particular announcement? She's given time for an adjustment to this. It's not going to come into effect until April 2029. But I guess this is pretty significant news, isn't it, for a lot of clients of advisors?
Well, it is. April 2029, you may have an election in between then. So
absolutely.
It's possible it may or may not come in. So that's probably worth thinking about. And actually, let's not forget that pensions and salary sacrifice still exist today. And they will next tax year, and they will the tax year after. So it's really important that we deal with the facts that we know. And actually, you may well find that clients decide they want to put as much in as they possibly can using those rules and that exist today. So I think it's really, really important that when we look at the plans, we still think about the true benefits of pensions and salary sacrifice. Obviously, what's happening is that it's the employee sacrifice that's converting to the employer contribution that is being caught. And therefore, there's no change if an employee makes contribution, and there's no change if the employer was making their own contribution outside of the salary sacrifice. It's only the salary sacrifice bit, and it's only and it's up to £2,000. I say only, it's up to £2,000, and so it's important to put it into some context. It's not great news for people, but obviously it dilute some of the advantages, but at the end of the day, you're still getting tax relief at your highest marginal rate straight away. You will still get some national insurance benefit as well. And that also depends whether the employer, which most employers did, would pass on the national insurance saving as well. But ultimately, not a great story for young people in particular who need to put money into pensions, and anything that deters them, no matter how big or small it is, anything that deters them is not great for young people in particular.
Now, she said that she was making this change in order to focus on lower income individuals and households. Do you think this is too disproportionately focused on that group relative to others within the population then?
I think, like all these things, it's a balance between, everyone has different requirements. Young people won't see the disadvantages for a long time with this change. So ultimately, it's a change that people won't really notice. It won't really appear in their pay packet. It won't really be seen for a very long time. And therefore it's a bit like the threshold. No one really notices the change, although the impact can be quite significant.
Well, moving from the pay packet to what you then do with the income that you have left over after you've paid the Chancellor, the taxes of the day, savings. Now, she's reforming the ISA system from 2027. She says to make it more attractive to invest in stocks and shares. So she's reducing the cash allowance from £20,000 to £12,000 for under 65s, retaining that full cash allowance for those over 65s. How do you think that's going to affect the advice that advisors give their clients?
Well, once again, not everyone puts in their £20,000. So for a lot of people, actually the £12,000 is more than they would have put into their ISA. However, where someone is putting in more money, first of all, the headline is you can still put £20,000 into your ISA, irrespective whether you're 65 or under. So that's the headline. The second bit is that if you're over 65, you still keep, as you said, that £20,000. And actually, if you think about the logic, for someone under 65, they have the time frame perhaps to invest for that longer period of time. So actually, most advisors are saying to their client, don't keep the money in cash, put it into the market. And if you put it into the market, you'll be better off. So actually, it is in line with what people would be saying to their client. And only if you needed that money in a cash environment for emergencies would you be putting the £20,000 into cash. So actually, it's not totally out of line with what an advisor would say. And once again, the headline is if you've got 20,000, you want to put it into an ISA, you can still do it. And if you're over 65, you will still be able to put that all into cash. And it doesn't happen straight away, which is the other thing. So there's still a lead-in time. Unlike all these announcements, there's lots of leading time for people to sit down with their clients, have the review, think about the consequences of those changes.
Yeah, I think if you reflect on what all those elements that Eddie said, all those, different impacts for different ages, different impacts in terms of when the implementation comes in, it's going to be impossible for people to just go online and find out what the budget means for them. Only people who talk to a financial advisor are going to get a tailored, clear picture of what the budget means for them and what the action plan looks like. And I think that underlines more than anything the importance of financial advice.
Absolutely, Matt. And I think one of the questions that some will have is about the new the removal of the two-child benefits cap as well, won't they? I mean, this is probably going to have implications for those who might be seeking to pass funds down through the generations, those intergenerational transfers. So another area that advisors, I guess, are going to have to be looking at over the next few weeks and months in order to provide the right advice to their clients.
Absolutely. And I think it's really, really important that advisors, and they're doing this already, is they think of the family unit. I might be talking to the grandparents, but let's think about the wider family. And the wider family may be benefiting from the removal of the two-child benefit cap. The wider family may be on other means-tested benefits. And so giving money to someone in the family that is benefiting here it's worth just thinking about, is this the right thing to do? Will they lose benefits? Is it better to put money into trust? Is it better to skip a generation? What's the right thing to do? Come back to Matt's point. Value of advice is so important, and actually just thinking about what's the best way to achieve the outcome I want without actually causing another problem by being generous or kind or whatever.
There was no particular significant, and it is significant for those that are affected, I'm sure, but it's a relatively small part of the population, announcement in relation to inheritance tax. The only mention was in relation to those that have been affected by the infected blood scandal, and they will not be charged any inheritance tax, which I guess we all fully support and is a real benefit to them. But no other mentions of inheritance tax changes this time around, so that provides a bit of clarity and makes things a bit more straightforward.
Well, nothing new. You're absolutely right. Apart from this really important change on the infected blood exemption. But let's not forget that pensions are going to be caught by inheritance tax from 2027. And for many advisors, that is means that they're having to change plans with their clients, think about the consequences of that. Some clients were not looking to draw down their pensions, and they may now well draw down their pensions and put the money into a different tax wrapper. So just because they're taking it out of one tax wrapper doesn't mean that there isn't a reason for putting it into another one. And that's something that I'm sure many advisors are thinking about.
Two other areas then I'd like your views on, gentlemen. So one is the council tax surcharge that's been introduced on properties of more than £2 million. So that's £2,500 on those properties and £7,500 on properties of more than £5 million. The Chancellor said she was going to consult on the proposals, but this could raise, in her view, £400 million by 2031. Matt, I mean, is this a change that frankly should have come sooner? Is it unexpected? Is it a positive?
It's a really interesting one, and it tells us so much about kind of the financial wealth and diversity of wealth throughout the UK. It's an easy target, isn't it? People who live in mansions should pay tax on those mansions. But of course, we know that because of the way house prices develop in the UK, there are a lot of people living in quite high value houses who might be living on quite a modest income and looking for the value of that house to maybe support them through something like long-term care and things like that. So it is a really complex picture. I think where you've got an environment where taxes have to go up because of all the commitments that the government's made internationally and at home, it's inevitable that property being worth, property stock being in the trillions is gonna have to contribute to that. But again, the implications for individuals could be quite profound. It's not just the case of billionaires, forking out a bit of money they never even thought about that they had. It's a question of families getting together, looking at kind of their kind of financial plans, and issues like long-term care are going to come into it.
No, very much so. So it's back into these intergenerational considerations again.
It is, and I think what's really interesting is it highlights the unfairness of the tax system. And she gave the example, didn't she, of two properties in the same band, one paying less than the other, even though the house is more expensive. And actually, if you think things through, reform of the tax system is a really important consideration for the Chancellor. And we started to see it, haven't we, Matt, with some of the changes to cars and fuel allowance. Absolutely.
So the increase for both electric vehicles and PEVs, and I guess that's one where you can see it's nice to tax bad things, whether that's sugary drinks or high polluting vehicles. But really, tax is there to raise money to pay for the welfare system and for national security. So in the end, once you've taxed all you can out of the bad stuff and perhaps taxed the bad stuff out of existence, the good stuff has to be taxed as well.
This is the new economy. We've changed. The equilibrium has moved, and therefore the tax system has to move with it. But bingo,
yeah,
we've seen all duty abolished on bingo. You a big bingo player, Matt?
Not myself.
You're not going to see much of an advantage.
I'm not going to be
this.
shouting house, but
I'm not. But I think we talked about before the change in the way that duty is going to be charged on imported items. There was that de minimis exemption, which is going to be removed. And as a tea drinker, getting tea from around the world, that exemption is actually going to have a dramatic impact upon tea imports for me. So I've been hit, and I've not gained from the bingo benefit side yet.
No, there might have been a few journalists shouting bingo when they realised the OBR had published the figures in advance.
Very good. Very, very good. Just a couple of other aspects before we draw to a conclusion. One of the changes that she announced was to venture capital trusts. And there's this remark in the budget document that doesn't have a lot of detail to it at this point in time, that they're going to reduce the upfront VCT income tax relief from 30% to 20%. What do you make of that, Eddie?
Well, this is a great example of the point I was making right at the beginning, which is you need to see the detail to really understand what's happening. And yes, you had equalization of upfront benefit for VCTs and EISs. It looks like that's going to be broken. It looks like there's going to be a smaller upfront benefit. Once again, it's not immediate. It's something that is likely to come in if the legislation passes. So we just need to watch that. And I think at the end of the day, it's once again an opportunity as we run up to the end of this tax year for advisors to say to their clients, if you want to go into a VCT, looks like there's going to be some changes up front. You may want to think about doing it this tax year rather than a future tax year when it changes. But like all these things, the detail over the coming weeks and months is really going to see how these things shape. And sometimes things just completely fall away, don't they? We've had it in the past where the reaction has been so negative, the government has just said, well, I'm not going to do that anymore. So let's see how it unfolds. But it feels like this budget is just taking a little bit from everyone and everything, rather than one big hit, and that hopefully will mean that it stays, pretty much static in terms of what was announced.
Well, talking about things falling away and things becoming a little bit more static than they might have been in the past, I suppose one of her key announcements that might have gone a little bit under the radar was that she's going to follow the IMF's recommendation to assess the fiscal rules just once a year going forward at the budget. A good thing, Matt?
I think so. I think we all welcome expert oversight, but when that expert oversight becomes a sort of running commentary, that can lead to speculation on an ongoing basis, and then trying to preempt the speculation with leaks and kite flying, and so I think a more measured approach, sort of cutting out some of the volatility in some of the speculation and commentary probably does help. I mean, as a professional body, we're all about improving trust, building trust in financial planning and insurance. And I think if that's done against a consistent background where we got milestones and we work on what we're working on until those milestones come along, that's a better way of interacting, but with the public, both the government with the public and the government with the fiscal system and professionals with the fiscal system. It just becomes a little bit more orderly and a bit easier to project to the public the sense that we are trying to build something that's consistent and valuable.
I think it's probably worth just reminding ourselves that they are forecasting increasing growth. Now that's good, And that should be good for financial advisors, because the best thing for financial advisors is for clients' plans to work. Clients' plans working require us to have growth, require us to have, good returns on our investments and stability. So I think that there are some really positive things in here. Also, the desire to buy goods that are made in the UK, and to invest in the UK, and government to buy in the UK actually should be good for the clients that our advisors are dealing with. So there's some really positive things. There's always challenges, but there's some really positive things for advisors. And like all these things, isn't it wonderful for an advisor to go and talk to a client and have lots of things to say to the client? This budget has given loads of things to say, 88 measures. So I think from an advisor's point of view, it's a really positive budget for conversations.
Brilliant. Well, I've certainly enjoyed this conversation with both of you, gentlemen. Thank you ever so much. As we said at the start, this is just an immediate response and reaction to the budget. We will be considering our own thoughts and more further responses over the course of the next few weeks and months, I'm sure. But for now, thank you so much, Matt Connell. Thank you, Eddie Grant, for joining me this afternoon on the podcast. We look forward to having further conversations in future.
Brilliant. Thank you.
Thank you.
Thank you for joining this episode of the Journal podcast. You can find more editions of the podcast on our Journal webpage. Please like, review, and subscribe.